So, Mike Mayo, talk to us about it, the changes that you've had to make to some of your base case assumptions for the coming quarters.
Well, I think you summed up our note fairly. There is no way to sugarcoat the impact of lower rates on banks. No large bank is immune. If interest rates stay at this level, we think earnings get hurt by 6% for each of the next 2 years. And we'd expect cautionary guidance from bank managements, come October or even next month, September, during the conference season. Having said that, even though we cut our numbers on Friday, we reiterated our buy stance on the group and the largest banks, such as Citigroup, Bank of America, and J.P. Morgan. Those are the more diversified banks, the banks that are not as dependent on simple spread revenues. And bank stocks have recession prices, even though there's no recession.
So, Mike, let's talk about it. The valuations versus the parallel to 1995. You came out very early in June, one of the earliest analysts on Wall Street to come out and talk to me about it, this parallel between the mid-90s and that the financials could do well in that environment. Is that a parallel that still holds for you, Mike?
Well, to some degree, because in the 1990s, the net interest margin declined, and that's what we're seeing now. Lower interest rates like we have can hurt the net interest margin, we think, by 30 basis points over the next 2 years. So that's a negative. There's no way to sugarcoat that. But just like in the 1990s, efficiency should still improve and bank stocks should still perform well. And the biggest factor is credit quality. Low interest rates means that credit stays stronger for longer, and that's the most important factor that drives banks. So when we talk about the impact of low rates on banks, it's not good. It's cuts, it's bruises, it's scrapes, but it's not the mortal wound that you can get when loans go bad.
Mike, just a final question to you on market bias and market perception. Investors still view many of the names that fall under your coverage as quite simply almost spread products, that what happens with yields ultimately shapes the bottom line for these financials. You and so many other people watching this program know that's not the case. But what will it take to really shift that bias, Mike? Really change the way investors view some of these names, because the way these companies do business has changed so much in the last 10 years.
Yeah, I think investors are looking at banks in the rearview mirror. They're looking at the group as if it's, last century. You have enormous structural changes taking place driven by technology that should allow the banking industry to become the most efficient in its history. So when you have better efficiency, the strongest balance sheets in a couple decades, and capital return that's at an all-time high relative to the market value, you say, you know what, you're worried about a few basis points here or there on net interest margin, you're missing the forest, the trees.